think we are. So I'll give you an example. In India, there's an auto manufacturer called Mahindra. And they, in fact, have their sort of chief of sustainability very much part of the key production manufacturing team that kind of reports to the board. And the chief of sustainability is kind of tasked with trying to see how the manufacturing process of the cars can be more green, can be more sustainable. And this is not something that company looks at as being part of CSR or corporate social, responsibility or reporting, but sees it very much as part of an essential business strategy where they feel that in the long run, that will make their products better, reduce the cost of production, but also make them much more attractive both in the marketplace as well as to shareholders. So I'm finding that in a number of Asian companies, this is now being or looked at as the way to go. In Thailand, for instance, Thai companies, as part of the stock exchange, have created a mutual fund where they are looking at investments in companies that actually have ESG reporting. And they find that those do better. Similarly, in China, CASV has launched, they started with 99 and changed it to 100. But 100 of the top companies that actually have good sustainability practices, and they've tracked their performance over the last 4 years, and they find they do much better on average. So I think in terms of your question, companies are doing this not because it's good marketing anymore. It is good marketing, but it also makes good business sense.
Out of those companies that you've given, I mean, there's still presumably a minority of Asian companies. Tell me about your sense of how quickly this is growing, and how confident can we be that within a reasonable time frame, by which I mean a time frame that will actually help achieve the goals of the SDGs, will Asia be able to reach critical momentum in that mindset within a reasonable time frame?
I would hope that they would be able to reach a critical mindset. My way of looking at it, or my take of looking at it, is it's also very heavily investor driven. And I run a network for funders and investors who invest for impact. The way I look at it is, how do you actually grow that pool of investors? Because if investors ask and hold companies or their investee organizations responsible, the companies will be much quicker to adopt some of these sustainability measures.
So there's little coming from within the corporations themselves. There's little coming out of the C-suite. It's all being driven from outside.
Some of it is being driven from outside. I think some of it is coming as a result of either peer pressure or, the feel that this is going to give them an edge. So if you look at it, Unilever announced their big sustainability strategy. I think it was just before the pandemic really hit us. But Unilever has always been a company that's tried to do things differently. It's interesting, right? But it also depends on public perception. And I don't know if you read, but yesterday or day before yesterday, they talked about removing Fair and Lovely, which is one of their biggest selling products in Asia.
Oh, they've actually addressed that, have they?
They've actually addressed that, which is, a long time coming, I have to say.
A very long time.
It's happened because, again, I believe of sort of public momentum, public pressure that's come about as a result of, this whole Black Lives Matter movement. But it's interesting, right? It's also shown us how corporates respond to...
But you're talking public pressure here. So, I mean, tell me about the balance between investor pressure and public.
So I actually think investor pressure, even though it's not as much public as public pressure, plays a much bigger role. Much bigger role. And in Asia, that could be the turning point just because of the number of family offices that we have and the kind of wealth that is controlled by these family offices. So I think, if you look at more and more investors looking at their entire portfolio and saying it's not just about, investing for impact or saying that, I'm going to take a discretionary or a discounted return because I'm investing in impact, but I'm actually going to insist on sustainable investing. I'm going to insist on investing through my portfolio in companies that do no harm, but actually that do good. I think that is going to be the turning point for Asia. We're finding a growing community RS Group was probably the trailblazer out of Hong Kong that looked at its entire portfolio. Where I think the sticking point is that a lot of financial advisors haven't caught up with this and are unable to help structure portfolios or unable to offer the kind of advice and guidance that investors need to be able to do this.
Interesting, because I began this conversation thinking, how can we think about helping corporates and C-suites to begin to deal with that transition from a slightly less committed mindset, shall we say, to a more ESG-minded mindset, but actually maybe we should talk about where you're saying the bigger impact lies is convincing the investment companies and the advisors to actually put the pressure on. And that will lead to the corporates making a change.
I'll tell you why I believe that. Because sometimes doing things or changing your supply lines or changing your production kind of flows to make them more green, make them more sustainable, sometimes costs more money. I'll give you an example. We had a family office speak to us at our conference, the Peterson Group from Hong Kong, that run a chain of hotels. Now, the hospitality industry has been greatly affected by the pandemic. What he explained to us is, he said, normally, in order to convince my board that I want to switch to a more green way of functioning, let's switch to having glass water bottles in all the rooms. Let's look at changing our air conditioning system. We would have had to shut down some of our properties in order to do this. And our boards don't agree because it costs money. The company would lose money. Now that we are forced to close properties, as a result, we have been able to put in some of these green measures because, we have the opportunity to do that. Why I'm telling you that I think investors play a very big role is that if investors actually choose to put their money where their conscience is, that is going to force boards and C-suites to actually think of this as being a far more profitable measure. And honestly, the market is what drives it.
So let's talk about those investors then. Who are the influential players in this? What kind of investors are these people, and how do we begin to consider their situation and perhaps try and affect it?
So there are a couple of groups here that I think are important. If you look at a number of, larger kind of multinational banks, especially if you look at European banks, they have come out with a very strong message saying that they will not invest in certain industries. And a few of these institutions have actually said that they will not also invest in those deals themselves, but not even invest in organizations that may be doing, sort of coal or fossil fuels in another deal. So they will not touch organizations that actually have, for example, fossil fuels in their portfolio. That's so you have some of those organizations which could play a bigger role just in terms of offering liquidity or offering lending lines to corporates who are either not green or who are very green and who are looking for, sort of more preferential rates of lending. But more than that, in Asia, actually, I think it's family office money. I think, rather than institutional lenders, I think family offices control the key in terms of making that ask, both from their own wealth advisors who are in different financial institutions, but also in the decisions where they make, where they want to invest their money.
And the majority, I think you'll agree, are still of the mindset that investing in the most profitable companies is what they need to do, not investing in the best companies.
Absolutely.
So chart a path for those people still in that mindset. How does change occur in an organization like that is still yet to agree that they need to think differently?
So I think part of it is the very clear mindset or the clear kind of left brain, right brain way of thinking, right? Where you think that, if I'm looking to make the world a better place, I am actually thinking through my philanthropic part of my wallet, which in almost all cases, unfortunately, is never more than 5% of your wallet. But, and the other 95%, I'm here to make money. And that's the reason I'm here. And that's what I have also told my investment advisors. But we are seeing that, there is now, unfortunately, a kind of blurring of those lines, or fortunately, a kind of blurring of those lines, where it is possible. If you look at the longer term, you look at sort of, what is the footprint that you're having, or what is the impact that you're having with your investments in terms of, future returns, what you're anticipating, it is possible to actually make a decent return, maybe make a market return, or even make a more than market return over the longer term if you invest in sustainable investments.